The Democrats and the Republicans agreed eventually to suspend the debt ceiling for 2 years in what is now known as the Fiscal Responsibility Act. Welcome to Key Points for June. This month, our take on the tentative agreement on the US debt ceiling. We look at the key economies of China and Japan and the divergences that we've seen in recent months. And we look at these two countries' stock markets, and again, we look at the difference of performance that we've seen since the start of the year. Will this be maintained? Now to our first point, we pointed out in last month's video that we felt an agreement would be reached in terms of the US debt ceiling, but it would be in the final hour. Well, actually, it turns out to pretty much have been in the final minute of the final hour as the Democrats and the Republicans agreed eventually to suspend the debt ceiling for 2 years in what is now known as the Fiscal Responsibility Act. Now, clearly that is good news, but it still has to pass the House and the Senate in the coming days, although we suspect that will indeed be the case because clearly, as we said last month, it's in nobody's interest for this to drag on. The US has never defaulted on its debt, and were it to do so, that would have long-term implications for both parties, increasing the borrowing costs of the world's largest economy. So that's certainly good news that appears to be being cleared up. Now, turning to our second point around China and Japan. You remember the Chinese economy surprise opening up quicker than many had expected from the COVID lockdowns, and the early indications were that that recovery was really quite brisk. We saw a lot of pent-up demand coming through. That noted, in the last few months there has been a bit of a slowdown taking place. When we look at things like the purchasing managers indicator for manufacturing, that is now actually fallen into contractionary territory. When we look at youth unemployment, that's above 20%. And the very important housing market still is pretty lackluster despite some support measures being put in place. Now, the service sector is doing better. Again, the purchasing managers indicator for services here is really quite robust in expansionary territory. But nonetheless, China faces some challenges ahead. And indeed, unlike some other countries, we find that the producer price index of inflation is actually in negative territory, and consumer prices also are very, very weak indeed. Again, unlike any other part of the world. Now, these indicators are allowing the authorities, we suspect, to embark on fiscal and monetary stimulus. It will be very targeted, not like the stimulus that we've seen in years gone by, but nonetheless, with growth somewhat vulnerable and inflation as low as it is, we think that this is now the time for a quite significant fiscal and monetary targeted stimulus to come through. That's important because remember the forecast the authorities laid out for growth this year was 5.5%. We suspect not only do they want to meet that, they want to breach that on the upside by year end. Now, turning to the Japanese economy, it has actually been doing better really throughout the course of the first few months of this year. Reopening has gone well. We're seeing tourists flocking back to Japan, and we're also seeing in terms of the domestic economy, both the service part and the manufacturing doing better as well. So again, this is quite an encouraging sign for what has often been seen as a very big but somewhat sleepy economy. Again, positive indicators coming from Japan. And that really takes us to our third point, because this is also being acknowledged by investors. The Chinese stock market is actually down on a year-to-date basis, and it's given up about half of the gains it made since the reopening. And this is in contrast to Japan, which has seen a fairly consistent move forward over the opening part of this year. Indeed, we see equity returns in the mid-teens type level. And this is as investors acknowledge not only the fact that the economy is doing better, but we're seeing corporate activity improve. Companies are focusing more on quite aggressive allocations of capital. We're seeing them focus more on stock buybacks. And all of this, of course, is encouraging investors. Also helped by the yield curve control that remains in place and a somewhat weaker yen over the period. So again, from a financial market perspective, although we're more concerned about risk assets generally, some of these trends that we've seen in China and Japan we think could last a bit longer. But in the short term, we think some of the relative performance of Japan versus China might be eroded a little bit in the months ahead. More broadly, we still think that equities and credit are at risk, but actually equities have held up better than we had expected, and we acknowledge that. We still think the greater risk in the near term is to the credit markets, where we've actually changed our high yield default rates for this year, raising them a little bit from 5% to 7%. Now, by historic recessionary standards, that's not terribly bad, but nonetheless, it is a move higher, and we think that small and medium-sized companies will still struggle in the months ahead as the availability and the cost of credit become more of a challenge for them. Remember, as always, you can read the full report on zurich.com/MSME.